If you're trying to accomplish certain financial objectives and estate planning goals, a trust may be used effectively in certain situations. In essence, a trust account is an arrangement where one person, called the trustee, holds legal title to assets for the benefit of another person or persons, the beneficiary or beneficiaries. You can set up a trust for a variety of purposes: to preserve assets, manage distributions, protect against creditor claims or litigation, provide for minor children or individuals with disabilities, or facilitate generational wealth transfer. Before we get started, there is some important terminology you should understand with respect to trusts. Settlor, sometimes referred to as grantor, is the person who creates the trust and transfers the assets. Trustee is the person or entity who holds legal title to the assets and has a fiduciary duty to carry out the terms of the trust. Alternate trustee or successor trustee is an individual or entity, an example would be Scotia Trust, appointed to take over the management of a trust if the original trustee is unable, typically due to death, incapacitation, or resignation. Trust deed, or declaration of trust, outlines the terms and documents the legal agreement on how the trust operates, distribution rules, powers of the trustee, conditions, and more. Trust account is an account held by the trustee for the trust's assets. This could be investments, cash, real estate, all held in the trust. Beneficiaries are the people or entities whose benefit from the trust's income and assets. You may be motivated to set up a trust for any of the following reasons. You want to protect assets for a beneficiary who may not be able to manage them on their own. You wish to control the timing and manner of distributions. You want to manage tax or estate planning concerns, such as avoiding probate, ensuring continuity, or splitting income with family members. You wish to segregate assets from the personal estate of the settlor, so that those assets are held off balance sheet for legal and estate reasons. There are two main categories of trusts: inter-vivos and testamentary. The first type, inter-vivos trust, is set up during your lifetime. This is set up by a lawyer through a formal trust deed. The second type, a testamentary trust, is established through your will. The will itself is the legal document that establishes the trust. With these types of trusts, there is no separate trust deed. Just as there are two primary types of trusts, there are two types of beneficiaries: income beneficiaries and capital beneficiaries. The first type of beneficiaries are referred to as income beneficiaries and are entitled to the income of the trust. They would typically be issued a T3 slip annually, distributing the income generated within the trust. The second type of beneficiaries are referred to as the capital beneficiaries and are entitled to the capital of the trust. This benefit may be immediate, deferred until a specific age of the beneficiary, or triggered by an event such as death of an income beneficiary. In many cases, the beneficiaries are both income and capital beneficiaries. Rules have been changing within the trust landscape over recent years. One rule that has not changed is the 21-year deemed disposition rule for trusts. Every 21 years, the trust is taxed as if it had disposed of all its capital property at fair market value. If you liked this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.